Okay, yeah. Treasury Secretary Scott Bessent, he's definitely emphasized the administration's focus on reducing long-term interest rates through a variety of policies, energy dominance, just deregulation, trying to find non-inflationary growth. So we know Scott wants to have lower long-term interest rates. Other people I've heard and I've talked to have said, well, Trump ought to also be interested in lower long-term interest rates. The simple and obvious reason is, well, who is Donald Trump? He is a real estate investor. What kind of asset benefits from lower long-term interest rates better than real estate? Like, no, it's just real estate. Have you seen any indication, anything explicit out of the Trump administration and their policies about their plans here? Or do we just kind of loosely understand that that's where they want to go without any sort of like concrete steps being made here?
So we have, I mean, in his first term, Trump fought with Powell a little bit, even though he appointed Powell because he wanted more dovish policy. And we've seen, so Scott Bessent was critical of Secretary Yellen's, what I mentioned before is that the Treasury purposely issued a lot of extra T-bills to fund a lot of their deficit, which was, they did that for kind of pro-liquidity reasons. And Bessent was critical of that practice. And yet he has said that in the kind of the first half of the year going forward, he's actually going to keep those policies in place, which he himself had been critical of. And one of the kind of implications of that policy is generally lower 10-year and 30-year yields, because you're issuing less of those really long duration ones that you might otherwise be issuing more of, and instead issuing more T-bills. So I do think that they're already erring dovish to some extent, but that's also somewhat doing damage control on, if you get a dollar spike because of aggressive tariff announcements, but then you also get the 10-year a little bit lower because you're not going to flood the market with duration. It's kind of a balancing fact. But yeah, so far, I would say that they generally are taking at least initial steps to try to get yields down. But some of the things could backfire later. Like the Fed is going to have to respond potentially to tariff policy and what that does for prices. And that could keep them a little higher for longer, which could keep rates up, keep the dollar strong, at least for a little while longer. And we could see kind of arguments later this year between Trump and Powell. So far, those haven't really surfaced yet the way that they did his prior administration, but they certainly could. I do think a big test later this year is that probably the Fed's going to have to end their balance sheet reduction because they're probably going to run out of liquidity. They can either do that or they can do some policies that enable banks to hold more treasuries. There's various like regulations that get kind of wonky that kind of affect how many treasuries they can hold relative to other liquidity things that they have to consider. So one way or another, they have to kind of stuff more treasuries into the banking system, and it could be at the central bank or the commercial bank level. And around the point where they have to kind of make that transition, that could be a little bit wobbly for markets and liquidity, and you could see some debate there between the two sides.
So understanding that we are in the era of fiscal dominance, as in not the Federal Reserve, but the government is in control of fiscal policy, and fiscal policy is larger than monetary policy. What leverage does somebody like Secretary Scott Bessent and Donald Trump even have over long-term interest rates? If they want long-term interest rates to go down, that's great, but they are not the Federal Reserve. They operate differently. So what level of control do they have over long-term interest rates?
So one of the levers they have is what I mentioned is the durations that they decide to issue. Now that has cost to it, like anything else. I mean, if you pick an extreme example, if an emerging market is having some sort of fiscal crisis, they could have all of their debt just be like one-day paper, and right. Just if no one wants to buy a 10-year Brazilian bond, they can just have everything be like 1 week or 1 day or 1 month maturity, and have everything be T-bills. Now the U.S. isn't doing anything that extreme, but by issuing extra T-bills, it's like a slightly emerging market type of move to basically say there's not a lot of appetite for this long duration stuff, so we're just going to issue less of it, and we're going to issue more of the short duration stuff that's kind of closer to money printing, and that there's more appetite for. So that's something that they can do unilaterally. They also have the Treasury has some kind of wonky things that they can do, like they can technically revalue the stated balance sheet price level of their gold that they have. And that can actually give them a burst of money in their spendable account that they can then spend it into the economy. That's kind of a break the glass move. It's like something that they haven't really touched in decades. So not a base case, but it's a move that they have. And then the other one is basically pressuring the Fed to accommodate. Generally speaking, when you have a sovereign bond market issue, almost always the central bank folds. So when the UK had the gilt crisis in 2022, the Bank of England literally canceled a speech on balance sheet reduction and went in with emergency temporary QE to buy bonds and to fix that. They could, on paper, they could say, well, that's a fiscal issue. You have to fix that yourself. But because they're responsible for the whole system and it basically was on fire, they said, okay, it's a fiscal issue, but we have to put out the fire first, at least. Similarly, when Powell and the Fed were facing, okay, we want to get inflation down, but a lot of our regional banks are in trouble. So they did a pro-liquidity, generally pro-inflationary move to favor the banks over rapidly getting inflation down. And they have kind of an unofficial mandate of market stability, that if the treasury market outright breaks or something, they kind of have to step in. So one thing the fiscal authority can do is kind of to say, well, we're going to stay on this track. And when we do get a really illiquid day, Fed knows what they kind of have to do. So they can kind of just push the Fed into doing stuff unless they want to be really, really standoffish, which I doubt Powell has in him. And then in addition, the lever they can pull is that when Powell's term as the chairman's up, they can make sure whoever they appoint is more friendly to them.
Yeah. So it sounds like if the Trump administration and Trumpianism, Trump fiscal policy, if he wants it to the long-term interest rates to go down, it sounds like my intuition from your tone and everything you're telling me is that he's probably going to be able to get what he wants. Would you agree with that?
I think so. I think at least in the moderate sense. And in addition, they have other policies in mind, like getting more energy production, which can make sure that's not a constraint. Right. That's more of a mixed bag, because one of the things I pointed out is that the Biden administration, despite all of their talk against energy companies, they didn't really do a lot of actions against energy companies that were really meaningful. A lot of the we did get back up to basically record production in the U.S. Post-COVID. But most of the reason why we're not even higher is because companies themselves have just not been strongly incentivized to drill a lot more oil. Oil's been in this kind of range-bound price area, and compared to the 2010s, they're not really getting a lot of external financing, oil companies, and instead they're kind of drilling out of their own profit. So every time they make a profit, they think, okay, do you want to pay off some of our debt? Do we want to pay a dividend? Do we want to buy back some shares? Do we want to build cash? Or make an acquisition, or do we want to kind of put fresh dollars into the ground and expand our production, which they generally only want to do if they're feeling particularly bullish. And so I think that's a variable that they can try to pull, but they have only kind of indirect action there unless they want to get really big in terms of like subsidizing energy or having really big policies around that.
Okay, so all of everything we've talked about so far has all been the fiscal policy side. And again, like you've identified, we're in the era of fiscal dominance. So that is the larger of the side of the equation. But I do want to hop over to the other side of the equation, monetary policy, which is just all the normal stuff that I think anyone would ask you if we were in a normal macro environment, which is just like, what's the state of inflation? What's the outlook for rates in 2025? QE versus QT. In this side of the equation, what's standing out to you the most? What's the tail that's wagging the dog here?
So what's standing out to some extent is that inflation's remaining sticky.
Okay.
And recent sentiment polls have detected that the public now thinks it's going to be a little bit higher. It could be because of the tariff threats. It could be from other things. Now, sentiment's always somewhat political. Like if you have a Democrat win, generally you'll get Republicans to be more bearish on a bunch of indicators and vice versa. So some of the uptick we've seen in inflation expectations has been more on the Democrat side, the way those polls work. But regardless, there's higher consumer expectations of inflation. And the actual numbers have been, even though we're here in early 2025, we're still not back down to the Fed's official target. And so that's kind of one factor that they have. In addition, we've seen an unusually hawkish long end, despite the cutting that they have done. So when the Fed did try to, moderately ease policy by trimming rates here and there, the long end went up. And so the part of the curve that people actually borrow in, mortgages, business loans, that kind of thing, that's not really been eased.
Right.
So there's still pressure on commercial real estate. There's still pressure on maybe not residential real estate prices as much, but certainly on volumes that are in turnover that are happening. A lot of that is pressured.
Right.
And so that's kind of still in a holding pattern. And then probably the couple big variables to watch is one, as long as the debt ceiling is being negotiated, That is ironically somewhat pro-liquidity because it could mean that the Treasury has to dump their cash into the market to keep paying their bills. But if we look past that, look toward more of the center, the middle of the year, the reverse repo facility used to have over $2 trillion in it. And that's basically excess QE. So they did so much QE back in 2020 and 2021 that they literally did more QE than their banks can even hold.
Hmm.
It's like pouring liquid into a bucket, and you're already at the rim. So any additional pouring in is just going to flow out of the bucket. And they did that, and a lot of the excess flew into the reverse repo facility, which they did on purpose because they didn't want it to drive T-bill yields too low because it would threaten their interest rate approach that they wanted. So $2 trillion plus flowed into reverse repos. And as the Fed has then shifted to quantitative tightening, the Treasury has tapped into the reverse repos by issuing all these extra T-bills. And therefore, they've been doing this kind of anti-QT that's about the same rate as QT. And so you have the Treasury offsetting the Fed almost perfectly one for one. That's now down to almost zero. So it fluctuates week by week, but it's something like $100 billion currently in the reverse repo facility. And when we look toward the center of the year, especially after any sort of debt ceiling complications that can occur and that's kind of normalized, that they potentially run out. And then you could have an environment where, much like the repo spike of 2019, the Fed has to kind of quietly go back to no longer doing balance sheet reduction and going back to either flat balance sheet, up balance sheet, or easier regulations to stick more treasuries into big banks. That's kind of their policy mix that they have. And the exact timing will vary, but I think probably by the end of the year, we'll see that. And that could be a little bit contentious.
And we are still in an era of QT, right? The Federal Reserve is still doing their best to tighten up liquidity, pull out liquidity. Even though we've cut rates like maybe once or twice, maybe two times, we are still having sustained high rates. High is relative, high for the last decade or so. So we have 4.5% interest rates, holding that, pulling some liquidity out of the market. We're still doing QT. The Federal Reserve is still doing QT, pulling liquidity out of the market that way. And the Fed is just doing that until something breaks, and trying to do that and absorb as much as possible before something breaks. Is that kind of the attitude?
Pretty much. So they already slowed it down once, and then they kept going. So there has been some debate within the Fed of how do we even know, like, when we run into a problem? Because in a perfect world, they don't want to do what they did in 2019, which is just they tighten, they break something, and then they put the fire out and go back to fixing it. They ideally don't want to do that. It's not the end of the world if they did. Like the repo spike in 2019, most people outside of macro don't even know what that is. Because it was just like financial plumbing thing that broke. Right. That's probably what it would look like when they break something again, which is things get messy, then they fix it. And they have internal models saying, here's where we think we're running into the danger zone. And they're kind of entering that phase now, but there is some degree of debate about where that zone is. So some might advocate to ending a little earlier. Some might want to push it a little bit more and say, well, let's try to find where that zone is. We've already kind of seen that their general plan is that whenever the situation comes up, they probably want to keep doing QT for their mortgage-backed securities, but end QT for the Treasury securities. That's kind of another hallmark of fiscal dominance. But it's from their perspective still trying to normalize what the balance sheet looks like, which ideally does not include mortgage-backed securities. So that's probably one of the ways that they're going to justify it is say, okay, we've hit the liquidity floor. We want to maintain financial stability, and so we're going to end, Treasury reductions on the balance sheet. Maybe even go back to mild buys, not like explosive QE, but maybe gradual QE. But we are going to continue selling mortgage-backed securities. I think that's probably the base case to expect.
And you don't have any indication of a timeline on, when there's too much liquidity pulled out of the market, or when the Fed's actions actually do break things, right? So maybe in the Donald Trump administration, by the end of his 4-year administration, we do get to a lower dollar and lower yields because that's what he wants, maybe. But there's a timeline on that. Is there a similar sort of timeline on this next era for the Fed's actions?
Yeah, I think the reverse repo facility winding down is like a clock ticking down. So it's like running out of time. Now it doesn't mean that when you hit zero, it's like you immediately go to QE, but it basically means that your liquidity buffer is gone.
Mm-hmm.
In addition, there are liquidity strains that happen at the end of every quarter. All the banks do window dressing, and they try to make their balance sheet look exactly like they want it to for their quarterly report. And so there's generally more demand to move money around literally in that day or two period. And so we've now had 2 quarters where there have been pretty clear signs of liquidity strain. So 2 quarters ago, someone had to use the Fed's repo facility. It was only $2 billion, but it was a new signal. And then in the most recent quarter, they didn't have to use the Fed's repo facility, but there was a pretty clear funding strain that happened. So everybody was able to get the liquidity they needed, but it was expensive. So every quarter, specifically at the end of the quarter, we get a little bit of a snapshot of either looking at the price of liquidity or needing to use the Fed's liquidity facilities to say, okay, what's the state of all these musical chair, the music's kind of briefly ending for a second. We get a little glimpse of liquidity constraints. That gives us some indication. And in addition, we're at kind of the rough targets. So they've talked about the balance sheet as a percentage of GDP being in like the 10 to 11% band. We're kind of already in the top end of that band now. And so whether or not looking at their kind of quantitative measures and then looking for actual signs of liquidity issues are the closest, and the reverse repo facility are the closest things we have to a clock. And they generally point to some action likely being needed in the back half of this year, probably.
If you enjoyed all of that, then you'll absolutely love the Bankless newsletter. Join over 300,000 fellow readers, all for free. Click below to sign up.